Welcome to the Explainer. Okay, today we are diving into something wild, and we're going to demystify a frankly brutal anomaly. I'm talking about that severe 10.5% single-day crash we just saw in silver on Friday, May 15th, 2026. We're going to peel back the layers here, separating the surface-level market panic, the stuff you saw flashing red on the tape, from the underlying physical realities. Because, spoiler alert, those realities are telling a completely different story.
Spot silver closed at $77.52 an ounce that day, just plummeting by $9.21. And, there's a really peculiar cruelty to an asset that falls 10.5% in a single afternoon, yet somehow, when you actually look beneath the hood, makes the absolute most compelling case for owning more of itself. Honestly, if you only read the headlines on Friday, you missed one of the most clarifying market days of this entire decade.
So here's the thing. When the macro world turned fiercely hostile that Friday, gold fell too, right? It dropped about 1.8%. But gold kind of absorbed the punishment with this composed, aristocratic dignity. Silver, on the other hand, literally hemorrhaged value. Which begs the million-dollar question, why did silver bleed so violently while its precious metal peer basically just took a minor stumble? Well, this brilliantly illustrates the structural irony at the center of Friday's session. Silver basically lives a double life. It has the conscience of a monetary metal, like gold, but the nervous system of an industrial commodity, kind of like copper. And because of this dual identity, when inflation data runs hot and industrial outlooks get shaky, both of its identities just get punished at the exact same time. It's a double whammy. All right, part one, the why. We're talking inflation, the Fed, and the paper reality. To really understand the anatomy of this crash, we need to look at how the dominoes fell over the week. It started Tuesday with a hot consumer price index, printing at 3.8% year over year. Then Wednesday brought a massive producer price index, meaning wholesale costs are just surging, completely throwing consensus out the window. That very same day, Kevin Warsh gets confirmed as the new Federal Reserve Chair on the slimmest, most partisan margin in history, bringing a famously hawkish record right to the seat. So by the time Friday rolled around, the market just buckled under the weight of it all. Just look at the gravity of these numbers for a second. You have a trailing 12-month PPI hitting 6.0%, with 60% of that advance coming from services. And remember, services are the one thing the Fed absolutely refuses to let run hot. Add to that a 10-year Treasury yield spiking to 4.59%, and perhaps most staggeringly, the University of Michigan's Consumer Sentiment Index cratered to 48.2. That's not just a pandemic low or a financial crisis low, that is literally the lowest reading since the survey even began back in 1952. When you combine that record low sentiment with yields spiking near 5%, ask yourself, why hold a piece of silver that pays you zero interest when a virtually risk-free Treasury pays you almost 5%? That harsh arithmetic right there is exactly what drove paper investors running for the exits. So the absolute crucial takeaway here is that 30 percentage points of monetary risk were violently repriced in just 7 calendar days. 7 days. The market went from comfortably pricing in 2 rate cuts for 2026 to suddenly assigning a near zero probability of a cut, plus a roughly 50% chance of an actual rate hike by December. Guys, this is not just a market calmly adjusting its expectations. This is a market running away in absolute terror. Moving on to part two, the geopolitical energy shock. Now, we have to remember that domestic inflation doesn't just happen in a vacuum, right? It's being aggressively fed by global supply chain gridlock and massive energy shocks happening thousands of miles away. Looking at the data completely neutrally, the recent U.S. state visit to China did yield a commitment for 200 Boeing aircraft, sure, but it left the really critical rare earth and semiconductor supply chain issues completely unresolved. And honestly, more importantly, the Strait of Hormuz remains effectively closed to standard transit volume. We're talking a drop from roughly 140 ships daily to just 30 crossings since Wednesday evening. Combine that supply chokehold with Saudi oil production sitting at its lowest levels since 1990, and you've got a perfect storm. This energy shock is basically a massive, glaring gap between expectation and reality. Think about it. Before the conflict, Q1 2026 expectations had Brent crude pegged below $60 a barrel. Instead, what are we seeing? West Texas Intermediate is sitting at $105, and the global Brent benchmark is up above $109. This energy shock is the fundamental, raw input driving the inflation that ultimately crashed silver's paper price. Which brings us to part three, the twist. Paper versus physical reality. Okay, here is the absolute stunning contradiction of Friday's crash. The silver that panic sold on Friday afternoon, it hasn't magically changed its molecular structure. panic on a trading screen didn't suddenly conjure up new silver atoms out of thin air to refill the physical vaults. The structural deficits haven't healed at all. What we're seeing is the paper price and the physical reality becoming entirely decoupled. Let's talk about the actual vaults for a second. Over the last 5 years, the local London silver pool, and remember, that's the actual physical pool backing the whole global clearing system, has drained by an astonishing 7,000 tons. It's dropped down to 27,454 tons, meaning it is smaller today than on any single day in the preceding 5 years. And over on the American side, the situation is equally tense. The COMEX delivery coverage ratio currently sits at just 13.4%. To put that into perspective for you, this marks the 7th consecutive month, 7 months, that this vital inventory metric has fallen below the critical 15% stress threshold. I mean, in January alone, 26% of registered inventory, the metal actually available to be delivered, just vanished in 7 days. And we know this isn't just some temporary blip. The Silver Institute is formally projecting a massive supply deficit of 46.3 million ounces for the 2026 calendar year. Industrial demand is forecast to hold super strong, above 650 million ounces annually, all while total supply is actively contracting. This absolutely cements a structural deficit that is now running for its 6th consecutive year. No way around it. All right, part 4, evaluating the bear case. Let's look at the other side. Because intellectual honesty completely requires it, we have to look at the real hard data that's suppressing the asset right now. The bear case is undeniably real. We're seeing tangible reductions in solar panel silver usage, what the industry calls thrifting, with photovoltaic demand forecast to fall 19% in 2026. Plus, we've seen over $2.5 billion in paper-side selling pressure from the iShares Silver Trust. Over in India, they just dealt a massive demand shock by doubling import tariffs from 6% to 15%. And on top of all that, major American appliance manufacturers are outright reporting recession-level lows in consumer demand. So naturally, all of this bearish pressure created a really violent financial compression in the equity markets. Mining stocks just plummeted on Friday. Fresnillo dropped 9%, Endeavor down 6.6%, Hochschild down 6.4%. Honestly, if you're holding mining equities, Friday was a brutal reminder of sector compression. It really reflects this terrible intersection where tightening credit conditions, skyrocketing energy costs, and sinking metal economics all just aligned against the sector at the exact same time. Which brings us to part 5, the impending market collision. So, what does this all mean? What should you actually take away from this? Well, we're basically left staring at 2 entirely different realities operating in the exact same space. A totally terrified paper market on one hand, and a rapidly, historically draining physical architecture on the other. It's creating this massive price gap. Now, while there is an honest acknowledged technical floor around the March low of $67.91, the vast distance between Friday's close of $77.52 and that all-time intraday high of $121.67 that printed just this past January, it is absolutely staggering. It strongly suggests that the underlying structural data, the draining vaults, the massive supply deficits, is simply not priced into the paper market yet. So as we look ahead to the new Fed chair's very first meeting coming up in June, the release of the updated dot plot, and of course, the ongoing geopolitical shifts over in the Strait of Hormuz, the ultimate question you really have to ask yourself is this: when do these 2 radically diverging paths finally collide? Is the macro environment going to compress the market even further, or is physical reality about to violently reassert itself over the paper narrative? I guess we'll find out.